so lose money. When you start talking about leverage products like futures and options, some of those strategies, you can actually lose more money than you have in the account. So again, it's extremely important to understand the different things that make up the risk model of the market that you're trading. So again, very important to understand. So give you a second to read through that, and we'll go ahead and get started. The mission of the Trading Pub is to provide a place for our patrons where they can hang out with some of the top traders in the industry. The pub is the place to receive quality education, all while interacting with traders and investors who are just like you. 3 things we try to accomplish anytime we have an event. Obviously, we want you guys to learn about the markets. We're very grateful for the guests that we have in the room today, and for Chuck and Jim both for taking the time to share about their experience in the market. We want you to enjoy your time here. You know, everything's better amongst friends, so let's all have a good time. And also, we try to put a focus on charitable giving. 10% of any revenues that are generated from Trading Pub go to charities benefiting the following causes. And we've got a big project coming up that's going to focus on inner city revitalization and workforce development. So we're very excited about that event that's coming up. We'll keep you updated. But it looks like we have a great crowd logging in. Just had several people join us, so we are very appreciative of that. If you'd like to find us on the web, our website is TradingPub.com. For those of you that are in the Twitter sphere, we're on Twitter, and we try to send out notices about any events we have, some thoughts on the market, a little bit of humor, and also we'll send out copies of recordings. So we get asked a lot, is this recorded? Can I get a recording? Yes, we are recording. Does technology always work? No, it does not, but we do our best to record these events and get them posted on our website, and we'll email a copy out to you following the event, hopefully this afternoon. So, but again, if you want to get copies of those recordings, you can follow us on Twitter or on Facebook. We typically try to post copies of the recordings there where you guys can go in and access them. All right, what I'd like to do is introduce our 3 guests that we have today. We've got EfremHoffman from NakedSwanTrading.com, Jim McQuarrie from StrategicDayTrading.com, and then Chuck Crow from www.dtitrader.com. So really appreciative of all 3 of you guys joining us today, and we'll go ahead and get started with the questions. Jim, we'll actually kick it off with you. If you could tell us a little bit about your trading strategy and how long it took you to find a consistent method in the market.
Sure, fantastic. And again, thank you for having us. We really appreciate the ability to come in and share with traders. And you know, this open communication between different companies and in different rooms, this is awesome, guys. And this should be done across the board because trading is for everybody. And the more we get together and work together, the easier this business becomes for everybody. It's a hard enough business as it is. You know, I've been doing this for about 18 years, and my start initially came from the options markets. And as difficult as this is to say now, I started out with a Wade Cook university course for about $12,000 way back in 1994, and that's where I cut my teeth in trading. Made a whole lot of money to start out with, and it was the worst thing that ever happened to me because I thought I knew it all, like most traders that start out making a lot of money. And so the next many years, I got my butt kicked thinking I could repeat what I did when I first started out, and it just didn't work out that way. And so slowly I migrated over from options into some stock trading, and then Forex trading, and then eventually into futures trading. And I got to tell you that I love the action and the liquidity in futures. It can be a little bit tougher to trade markets like oil and gold, things along those lines, but they can certainly give you the reward is there as well, as long as you understand the risk that's involved. You know, my techniques in my trading really are developed around very simple techniques and trading techniques. My philosophy is, if you make it too difficult, regardless of how good it backtests, you're not going to trade it. You're not going to follow it. I don't care if you have a system that is, you know, 80% profitable and gives you these huge reward to risk ratios. If it's complicated to follow, you're not going to follow it. You're going to lose focus. You're going to miss trades. If you're trying to follow too many markets, same thing. Keep it simple. Trading becomes easy. I'd rather take a system that's not quite as profitable but easy to trade, because I know in the long run I'm going to make more money from it. I like entries off very simple things like trend line breaks, using a higher time frame for direction and area, and a smaller time frame to enter on simple trend line breaks, head and shoulders patterns, just very, very simple pullbacks to areas, very tight stops, breakouts if I get a nice area to put a stop behind. And that is really how everything I do is developed and built around some overbought, oversold areas in the direction of a trend using a filter that we use in the room. And that's pretty much it, guys. Nothing more difficult than that.
All right, good deal. Appreciate you sharing that. And again, we're excited to have you as part of today's event. All right, Efrem, if you could tell us a little bit about your trading strategy and how long it took you to find a consistent method in the market. All right, Chuck, I think he's working on some audio stuff. Chuck, if you could tell us a little bit about your trading strategy and how long it took you to find a consistent method.
Yeah, sure, Morgan. Well, the trading strategy that I use is very similar to what we teach here at DTI. It's kind of a common sense approach to the market. I'm going to look at certain numbers. There are certain times and numbers that I like to use, put them together, and see what the indicators look like at the time. And really, it's just understand some of the fundamental natures of the market. And I'm not talking about market fundamentals. I'm just talking about things like, well, this sell-off that we're seeing right now in the S&P futures, probably a little bit of it. We can point to all the news we want and reasons for why it's doing this, but at the end of the day, if you sit down and say, we're trading right now, we're about 6.5 trading days away from the end of the first quarter, and this first quarter has been a very positive quarter. So doesn't it make sense that there might be a little profit taking going into the end of the quarter? Little things like that. Common sense, I think, is something that really gets thrown out the window. And one of the reasons why is you look at trading schools and things that go on in the business, and there's this attitude, why don't we complicate things a little bit? And like the speaker just before me said, if it's too complex, it's probably not going to work out that well for you. You want to keep things simple, and having a simple understanding of the way the market develops, I think, is really the best thing that you can do. And of course, you want to use tools that are going to help enhance that understanding. So we look for indicators, we look for certain patterns that exist in the market. But I'll say this, as far as finding a consistent method, I think one of the great truths about whether it's futures trading, stock trading, options trading, any type of trading you're doing, these are chaotic markets. And what we're looking at to a certain extent is kind of a controlled chaos event. So I don't ever expect the market to do exactly what I think it's going to do. And I think that is probably the most consistent thing I can come up with, that the market is far from consistent. And as a trader, I'm always watching, always learning, always developing. And as I don't know if you ever get to the point where you're satisfied with some sort of a consistent method. It's all about, you put the approach together, but you understand that markets change, markets develop, and what was true yesterday may not be true today. And just use a little common sense when trading. I think that's the biggest thing for me.
All right, thanks, Chuck. And yeah, you definitely have to have some common sense. And Efrem, is your audio working now? Can you do a sound test? Okay, all right, we'll move on. Jim, if you could share with us, what were some of the most painful experiences you've gone through in your search? So what were some of the struggles that you had to overcome?
Well, that's a pretty simple question. A couple blown out accounts initially, a loss of 40,000 in a one-day period on overtrading the S&Ps early on, and so some very, very tough struggles. And a lot of that had more to do with the fact that I just really didn't know what I was doing at that time. I was following a set of rules, I thought, But what I didn't do is I didn't have a good mentor. One, I thought I could do it on my own. Number two, the rules that I were following, I really were not, I was not following those rules. At the end of the day, I wasn't going back and doing the homework that needed to be done. I was really trading off the cuff, even though I had a set of rules and wasn't following them. And it's very, very important as a trader that you guys realize this is not easy work. It's a business, has to be treated as such, and if you want to get past those painful experiences, you guys have to treat it as a business. And a lot of homework, a lot of time behind the charts, and really specializing in a specific market.
Yeah, and I think that's something as a new trader that a lot of people kind of make the mistake of feeling that they think that just all of a sudden, they open an account, get the latest indicator, and are going to start money. We actually had a blog post about that said, if you think a trading account's just an ATM, think again. And but it takes years and years of experience and lessons learned. And I know that I really appreciate, and I'm sure the people in this room appreciate you and Chuck and taking the time to share from some of that experience to hopefully save them from making some of the mistakes. So thanks for sharing that. And Chuck, if you could, what were some of the most painful experiences that you went through in your search to develop a trading method and become a consistent trader?
Well, I got lucky in that I had a pretty good mentor who kind of was showing me the ropes a little bit. So I don't have any huge blown up accounts, but I certainly have blown up days. I think the first painful lesson was, despite everything I know about the market, I can be wrong. And I think that's one of the things as traders, we have to have confidence in what we're doing, but there has to be a certain amount of humility, because if you just keep fighting the market and you say, I'm right, darn it, and it's going to go the way I think it's going to go, the first major lesson you learn, the market is far more arrogant than you can ever be. You're confident in your abilities, well, it's bigger than you. I think that's really the first big lesson. And, we all have that taught to us, whether it's a very bad day, a very bad week, a very bad account. We all get that lesson taught to us. The question is, how do you react to it? And there are a lot of people out there, and Morgan, you've heard it before, the market's out to get me. Well, this is where having a little bit of humility has to come in. As a trader, you've got to be extremely confident in your ability to trade. But you don't want that to go overboard. You also have to be humble enough to understand you're just one trader. There are millions of traders out there, and the market doesn't really care about you. It's sort of like I've done a little tech support in my time, and I remember talking to someone who was telling me that they needed a firewall because hackers were out to get them. And listen, hackers are out to get the DOD, the FBI, the government, and maybe the rich people. And every now and then, sure, a hacker might come across a normal person. But for most of us, simple firewalls and stuff like that work. The market's not out to get us. It's just that some of the things that we learn in terms of risk management, other people know that too. If I look at the market trading right now at E-mini S&P's at 1386.75, and if I made the argument to you that, if we can't get back above 1390, then it should continue going lower, and you put a stop at 1390.75, it gets hit, and you're out there saying the market was out to get me, no. That's just the logical place that you would want to have a stop. It's not out to get you. So that was the first thing, and it was kind of painful to know that I'm not the most important person in the world, but it's something that every trader, I think, needs to be taught at some point.
All right, great. Thank you very much, Chuck. And we'll stick with you on this next question. What is the main indicator or maybe market or thing that you look at when you're looking to enter and exit a trade?
Well, the market that I'm always using to judge the overall picture, it would be the E-mini S&P. And when you just look at the type of volume that flows through that market on a daily basis, if you really want to know how things are going, the old saying is follow the money. And Most of it is in the E-mini S&P futures. As far as futures trading goes, is if I'm not mistaken, the largest futures contract in the world. So that becomes a primary market that I'm paying attention to. As far as indicators, entering, exiting, and making snap judgments, I think the NYSE tick is a great indicator in terms of it's kind of a momentum type indicator. You can get a sense of how things flow there. If you've ever driven a stick shift, and Morgan, did you ever drive a stick shift? I'm not sure if you did or not. Yeah. That'd be interesting.
Actually,
Throw that back
have
at
not. So
you have not. Okay, so this might be a little bit difficult to understand for people who've never driven a stick shift before. But if you think of the tick, add an extra 0 onto it, and think of it as an RPM gauge. Of course, you have negative numbers, but go absolute value on the here. And what you see in the flow of the tick is very much like what you would see in an RPM gauge if you're driving a stick shift. So you have the engine rev up, you switch gears, it comes back down, it catches again, and it really does act like that. It's kind of one of the, I think, a great indicator if you know how to read it. It's kind of like an RPM gauge. It's a great indicator for driving a stick shift if you know how to drive a stick shift. So anybody who's ever used a car with manual transmission will be able to see that tick and go, oh, I get it. That makes sense. If you haven't, it might be a little bit more difficult to comprehend, but I know that you've hung out with traders here at DTI, so I know that you kind of get that. But you look for that momentum, and often what you'll see, in driving a stick, you'll have some times where you miss the gear. You don't get the car in gear. It's in neutral. Step on the gas. The RPMs go way up, but the car goes nowhere. If you see something like that going in the tick, let's say it goes from, right now it's at negative 216. If it comes up to 1,000 and the S&Ps go nowhere, I look at it and say the market didn't get in gear. So we can kind of make that analogy and be able to connect things so that you can understand them a little bit easier, I think is big here. But as far as, what is my primary indicator? Well, my primary market would be the E-mini S&P, but my primary indicator has got to be that NYSE tick.
all right, great. Thank you for that, Chuck. And are there certain levels, like if it's been ramping up and it gets to that you'd say, okay, this thing's overdone? Is there any, like, a particular hard number that you look for?
Well, I think 1,000 is a pretty good mark. If you go past 1,000, you're pretty much at the end of that cycle. The tick generally doesn't go much above 1,000. So consider that it's a momentum indicator. So indicating the highest amount of momentum doesn't mean I've got more momentum coming. It means I just had a lot of momentum come in. So that can be kind of a topping action. But we've seen very fast ticks that can go up, drop back down, go back up. Do I actually use the tick for trade entry or exit? Well, Peter, I'm trading based on the numbers in the market, so it would be on the E-mini S&P. I'm using the tick to sort of confirm whether or not I should be getting into that. If I get into a trade and I see the tick and it starts showing me signs that that momentum may be topping out or maybe dropping away from the market, then I'm going to be looking to exit pretty quick. But no, I'm not going in and saying, okay, the tick's positive 300, buy. I'm going to make my buying and selling decisions based on whatever market I'm trading in. I'm going to use the tick as an indicator to let me know if those are good decisions or if I need to revisit them or reevaluate. So I'm never going to put everything on one indicator. I think that's a little bit foolish. We always want to have a myriad of different indicators. You don't want too many because you don't want to get overwhelmed, but you certainly need more than one point of view to understand what you're looking at.
All right, great. Thanks for that. And Jim, what would you say is the main indicator that you use when looking to enter or exit the market?
Everything that I need is right there on the chart in the bars themselves. The bars tell me everything, and then the money management behind each trade is where I make my money. It's not on any specific indicator itself. I'm not a big indicator fan. We have some. We use them to help gauge the market, but the price bars themselves, I read those price bars. I read the price action. We read the what the market's telling us on one higher time frame above, and then we enter on the smaller time frame based on very simple price action. So everything I do, again, is built into those bars. Reading what the traders are doing. Are we coming up to areas where I know psychologically the areas may hold based on days high and low, Fibonacci areas, balance points, pivot points, all price action based and all chart based. Very simple techniques. I use a special bar that we've built very similar to a Ranko bar, and depends on the market weight. The market could be, let's say, for example, oil. We'll use a 6 Ranko or an 8 Ranko style bar. If it's my currency markets, whether Forex or whether the cash or the futures, we would use maybe a 4. Russell might be a 4, and so on and so forth. E-minis, I would have to drop all the way down to a 2. Because while you might get 4 points on the E-mini, we might get double the ticks on the Russell or triple the ticks on the CL.
All right, great. Thanks for that. And I think we've got our third guest on here. So give me 1 second to dial him in, and we'll pick up with his answer to this. Just give me about 20 seconds here. So appreciate your patience with this. Just had some audio difficulties. And so, Efrem, the question to you is, what is the main indicator that you use when looking to enter and exit the market? We'll give him a second to get on here. Hey, how are you doing today?
Hey, how's it going?
Going fine. The question is, what's the main indicator that you use when looking to enter and exit the market?
The main indicator I use to enter and exit the market is it's not one indicator. What I do is I overlay on a price chart forward-looking lines of what zero momentum will look like to different traders on different time horizons. And when I see a confluence of decision makers making decisions around the same price points based on their changes in momentum indicator, then it gives me an idea when a lot of buying power or selling power will come in with volume in the market. So, and then I compare that potential buying and selling power to previous pivot point areas where volume has either come in light or heavy in the past. And if it appears that these forward-looking indicators of momentum across different time horizons are indicating that volume is going to exceed the prior history, then it's telling me that smart money is flowing into those areas. The other thing I look at is the global macro picture, that sometimes one asset class won't tell you the whole story, because it's sometimes easier for money managers to move certain markets. But if you look at the gamut of commodities and the futures markets and then see which inputs and factors of production are impacting certain equities and studying, like if oil is going to be moving strongly in a certain direction, how that would impact a certain stock, then you could kind of line up 3 or 4 different asset classes that are all telling the same story for a specific equity that you're trading. If you're just strictly trading futures markets, then I will also look at what equity, smart money in the equity markets that are tied to those commodities are actually doing. And if a lot of times what I'll see before major breakouts in certain commodities is a lot of buying interest off of a period where there was very low interest in investors trying to get into, let's say, an oil stock or into a certain steel stock. And right now, one thing I find very interesting is that looking at the commodity markets, it looks as if agricultural commodities are about to take off quite nicely. I'm looking at rough rice, I'm looking at wheat, and a number of other ones. And when I look at the DBA, which is an exchange-traded fund in the equity markets, it's also showing the potential for strong outperformance and a mean reversion towards levels that could produce a fairly interesting trade.
All right, great. Well, thank you very much for sharing that. And Jim, we've got a personal question for you. As a seasoned veteran, you've got 18 years of experience. What advice would you give a new trader that's struggling in today's market?
Get a mentor. That's the first and foremost. And the reason for that, and you've got to do your homework behind that mentor. You've got to talk to other traders. I wouldn't necessarily listen to the forums. I would go to other traders that have been in that room and talk to them about that specific mentor, and then see if it fits your style. That mentor needs to fit how you want to trade. And because I can promise you this, you're going to pay for your education one way or the other. And I can tell you firsthand, it's a lot more costly to try to do this on your own than it is to find a mentor to help you guide and get you through, what not to do in order to keep your account safe while you're learning how to trade. All right. So that is first and foremost my advice. Get a mentor. Second thing is put your ego away. All right. It's not about being right or wrong. It's about following your rules, being consistent, staying in your trades according to what your plan is, and not changing that plan intraday. And that's also a very, very important thing. The market doesn't care what you think. It's going to do what it does. You trade from the right edge, and it's always easy to armchair quarterback halfway through the day and look, we could have caught that or caught that really at the right edge. And so you got to put the ego away, guys, and let the market tell you what it's going to do.
All right, great. And again, we really appreciate you being on here, Jim, and would love to have you back for a future event as well. So thanks again for taking the time to join us today. All right,
thank you. I really appreciate
Efrem,
that.
Absolutely. Efrem, how do you balance quantitative research with your personal emotions or bias in the market?
Well, that's a very interesting question. If most of the time when I look at something intuitively or just what I think, separate from what the actual technicals are telling me, I'll be almost always wrong. And but after I actually look at the complete picture of what the technicals are telling me across different sectors and commodities, then it gives me a pretty good picture, and then I tend to be aligned with what my strategy is telling me. But if I only focused on, let's say, equities, to make a decision on what I'm going to do in the equities market, it doesn't give me as much confidence in trading that market, because there's other information that coming out of the commodity markets or currency markets that could be impacting that class. So even if I'm not trading commodities, I would say that new traders should start to try to understand some of the global forces that impact those prices of equities, because by doing that, a lot of the black swan events that people were unaware of, they could have actually gained insight on some of those things.
All right, good deal, and we appreciate you being with us today. I'm sorry about some of the difficulties, but would love to have you back for a future event. So thanks again. All right, and Chuck, the question we have for you is, I know you're a big numbers guy. What are two major areas of support that you feel the market needs to hold to continue its bullish run? So what are two big areas that you're watching?
Well, first of all, I think until we get to the 1st of April, there's a lot that's still undecided about the market. But the open of the month right now is 1362 quarter. I think that's going to be a big number. Although it wouldn't shock me at all to see the market come below that. I don't know if it really has the ability to pull back as much as a lot of people might wish for. But I think the 1350 level, I think, is a very big one, because at that point you actually put on kind of a technical situation here, where based on the range we've had in the market so far, which is about 149 points, despite the fact that everybody's talking about how huge this rally is this quarter, it's 149 points in the E-mini S&P. That's big, but we've seen bigger in the past. Consider that our ATRs, our volatility, is a little bit low. The market currently is up about 112 points. It opened at about 1275. So if we take that 150 points, cut it in half, that should really give you a real base of what might be a good support level in the market. So about the 1350 area, 1349 quarter to be precise, that's really one of the big numbers I'm looking at. And I think you could go even a little bit lower than that. In the S&P futures, let's be honest, as long as we're above 1274.75, it's a positive year. In terms of support, there's a lot of it that exists. The bigger question, I think, is more about the resistance side. You know, Morgan, when you look at this market, we've been trading this week or this year. I think this is the 13th week of the year, if I'm doing my math right. And 12 of those 13 weeks, including the current one we're in, have set a new high of the year. So the bigger question is, where is the resistance? And right now, the best guess you got is 1408, which is the high of the week. So I understand that everybody wants to know about the support because they're looking for the market to pull back, and you know, certainly if it's going to pull back, this is the time to do it. And I'll give you the 1350. I'll give you the how about the open of February, which was, if I'm not mistaken, about 1307.75, 1308 area. Those are probably going to be two big numbers. So go back to the opens of the months as your big numbers, and I'll throw in 1350 from a technical standpoint. The bigger question to me is, what's the number the market can't get above? And the answer so far, every week this year, except for that one, the week before last, was there's not one.
All right, great. Thank you very much, Chuck. And again, we appreciate you taking the time to be here today, and definitely have you back in the future. And so be sure to check all three of these guys out at their websites. It's www.NakedSwanTrading.com. Jim's website is www.strategicdaytrading.com. And then Chuck's website is www.dtitrader.com. And guys, as far as the formal interview, it's over. We do have a couple questions in the chat area if you guys would like to answer, Chuck or Jim, if either of you are able to answer those questions via type or come on and voice, you're welcome to do that. But we really appreciate you guys being with us today. We'll keep the room open. Our next event is going to be at 3:30 Central Time today, and so you're welcome to stick around for that event. And like I said, we'll just leave the room open for that, and we'll be back in about an hour and a half for the next event. It's going to be on Apple and SPX option trading. So we've got that, and then just our way of saying thank you to you for being here today. If any of you would like a free copy of SFO Magazine, which is Stock, Futures, and Options, and also has some Forex information, technical analysis, psychology of trading, we've got a deal with them where you're able to subscribe by clicking that link below. So Chuck and Jim, if you guys would like to pipe in and answer those questions that Pete and Fode had, then you're more than welcome to. We appreciate everybody being with us today and look forward to having you all stick around for our next event and come back to future Trading Pub events.